You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market, from unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tosaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. And now, get ready to hit the option block.
Good afternoon and welcome to the Option Block, your bi-weekly source of all things option trading. If I don't sound like the baritone voice, the sultry voice of Mark Longo, well, you don't turn your dials just yet. You're still in the right place. We have a skeleton crew today. The workers are fewer, but the harvest is plentiful, I can assure you of that. Mark's attending the Options Industry Conference in Arizona this week, and he will have an update for us on Monday's show. There will be interviews from the conference, so make sure that you stay tuned to the Options Insider website for more information on that. But today, in the hour of umbrage, well, we're not going to claim too much umbrage because we don't have the umbrage king on the show today. We do have his trusty sidekick, his partner in crime, the man, the myth, the legend, the greasy meatball sandwich, Mr. Mark Sebastian. Mark, how are you doing today?
Did you just describe me as Andrew's sidekick?
That's what I thought you are. Is he your sidekick?
Well, we're each other's sidekick.
Well, there
We're
you
a
go. So that means you're
duo.
his sidekick.
Well, really, he's mine.
Okay, got it.
He's my sidekick, but he's not. Yeah, I was just thinking to myself, Mark has a voice that would match your build, Like when you walk in the room, I would expect you to sound like Mark. And when Mark walks in a room, I'd expect him to sound like you.
I can see that. I do have a kind of higher voice for the alignment with which I have.
Yes, for the girthiness of your arms, neck, and body.
And belly, let's be honest.
Neck and arms more. But it's been fun. Listen to all the shows and everything. Things have been good. Kind of a weird day today, right?
I would think so. I mean, I think that just over the course of the last couple of weeks, Mark and Andrew have just kind of been making fun of me because I'm looking at the VIX so much. It's like Bizarro World. I have my eyes on the VIX, so I can't wait to hear what you have to say about it today. Well, so without further ado, what's going on with this thing we call the VIX?
Well, you know what? When the market doesn't move, it's hard for the VIX to rally. So, if you look at the 10 VIX that we have, it actually is expensive relative to where it is historically in comparison to movement. So movement the last 10 days been about 2.5%. That's a 7.5 point premium. So for instance, when the VIX, it was at 17 last, movement was around 15%. So it was only trading at about a 2 point premium. So
then you say movement, are you referring to like 10-day movement?
10-day movement of the S&P.
Got it.
And so, people look at it as cheap. I look at it as expensive. Now, historically, is it low? Yes, but is it cheap? There's two different things, right? So Snapchat got a lot cheaper today, but does that mean it's a low price? We've seen just how resilient markets were. I think during the FBI testimony today, when the director basically confirmed that the Justice Department was not seeking more dollars for the investigation, and it had really nothing to do with Comey, markets did better. Like I said, dollars trump hate. Dollars trump hate for Trump is what I think it ends up coming down to.
Yeah, I would say so. It was an interesting move today. And then you'd also mentioned Snap. We were talking about them on the show on Monday. I believe the straddle was $3 going into earnings. We had talked about it a little bit. And I think all three of us had figured that there would be no way that Snap would get a $3 movement from the earnings. And good thing I don't trade earnings is all I have to say on that one, because holy cow.
Yeah, wow. Do they stink? What a, and I mentioned this in my column for the street today. I was talking to Lauren, and she did a collaboration a couple of weeks ago with a relatively large retailer where they were requiring her to do certain types of social media activity. And so they wanted her to do an Instagram post. They wanted her to do an Instagram story, and they did not even ask about Snapchat. And this was the second time she'd had something like that. In her kind of media stuff for a convention she went to, they asked for her engagement and in Instagram and even Twitter, and did not ask about Snapchat. So I think the retailers still don't exactly know how to use it or what they're dealing with. And really, if you look at their audience, their entire audience needs to ask their mom for money in order to buy something. That's a problem.
That's a good point, unfortunately. I wish that wasn't a good point, but unfortunately, I think it is. Most of the audience does need to ask their parents if they want to buy something, and most of the audience apparently is either teenagers or 23-year-olds that don't have enough money to buy anything anyway.
Yes, millennials don't have money, and super millennials or teens or whatever they're called, they don't have any money either. So that is a problem, and that's their audience. Twitter is an old audience. Facebook is an older audience. It's Facebook and Instagram is just where all the money is.
That's what it appears to be, because I guess Facebook seems to be like what the internet is now. Because the Viceroy, I remember in one of his last shows with us, he was just saying that Facebook's so old that I even use it. And he does. He's actually very active on Facebook, I've noticed. But
he is active on Facebook.
Oh, very much so. And but on there, older people are becoming very active on Facebook. My mother-in-law is very active, and she's in her, I think she's 83 years old. And so there's a lot of older audiences that are active, and you're right, they don't need permission from their mom and dad to buy something.
Right. And, my wife's grandmother is on it, and she's 90. My wife's parents, my parents, the least technologically savvy people in the world, are on Facebook and use it.
What's going to be interesting to see in the next few years is, of the social media stocks that exist right now with Twitter, Snapchat, Facebook, I don't think Facebook is going to be a bust, but it's going to be interesting to see which ones go the way of Pet Store, shoelace.com.
Pets.com, yeah. I honestly think Twitter's got a good product and bad management. Snapchat has a bad product and bad management. Facebook has a good product and great management. And Twitter will end up getting acquired by somebody similar to LinkedIn. Who wants Snapchat? I think Facebook tried to buy them for like $1 billion back in the day. And Facebook may end up buying them for $1 billion several years later with a much bigger base. Because I just don't see them as a long-term advertising answer. I think they could be very specialized, but I don't think they're a standalone company.
No, I would agree with you on that one as well. A couple other things that are going on in the market today. There's some earnings. We can talk a little bit about that and around the block. Some other things that I thought have been interesting the last couple days, and I'll kind of tackle this one, but if you have some thoughts on it, feel free to chime in. Oil appears to be coming back from the dead in a tiny manner over the course since I'm just showing a peak here about a month ago. Oil was in the low 50s. I'm showing the high of 53.76. Bottomed out at $43.76 about a week ago, and today it's back up to 47. Whether this is a dead cat bounce or whether this is a time to buy at the bottom, I'll leave that to the listeners to decide. I'm such a long-term oil bull. In the short term, I'm probably a little bit skewed in my view of it. But nonetheless, we did actually, what I think is ironic over the course of the last week or so with oil, we actually had announcements from the Saudis saying that they would agree to continue to cut production, and then oil did not rally on that. So
that's crazy.
It is.
And that is a real problem for that's a real problem for oil. If they're not gonna, if they can't even rally oil on like this kind of production cut, there's a real problem here. And, maybe it has something to do with the fact that every time they reduce their inventory, it just invites the Americans to ramp up production. I think that's a little bit of it.
Yeah, it could definitely be that. And then, of course, the contrarian point of view would be you'll notice that it did actually come down a bit going into that announcement. And then maybe the market knew before that announcement was going to happen, because over the course of the last month or so, we are down from 54. So that would be the other thought on it, is that maybe the market maybe knew that was going to happen, and then now that they're actually taking profits from that a couple months before. So I mean, that's the other thought behind it. Who knows? Are you guys looking at any volatility plays or anything like that in the slippery stuff?
In oil, not as much. We spent a lot of time looking at USO, but the vol's not that high. The last time it broke, vol was a lot higher, so it's not moving around very much. You'd be surprised that there's been almost no lift in USO.
All right. Well, without further ado, that is going to conclude our trading block for today. And it is Thursday today, so this will give Mark a chance to rest his voice a little bit, hit the mute button, take a few sips of Gatorade, water, beer, whatever he may be drinking. I'm going to do that. And this is where we get to sit back, relax. And this is when normally Mark would say I'm coming down from the mountains, but since I'm hosting, I'm already down from the mountains. And this is when we are going to do the strategy block.
It's time to dispense options, wit, wisdom, and education. It's time for the Strategy Block.
And welcome to the Strategy Block, everybody. I want to go through a strategy today that I think is, if you are owning underlying, this is something, and you're a covered call trader, or you're doing a wheel trade or something along those lines, I think this is something with which you can investigate in your trading toolbox at this point. At not necessarily, I'm going to say give two different strategies. One of them I think would be more relevant right now. One of them I don't think will be more relevant unless the VIX were to get, or unless volatility were to get higher. But the first one that I want to talk about is a horizontal ratio spread. Now, what I'm looking at right now is SPY. And once again, this is not a trade that I'm in. This is not something with which I'm doing right now, but it is something that I might be looking at in a few individual stocks. SPY right now, it's trading at $239.38. That's the close today. And let's take a look at the June. I'm looking in June right now, and we are going to take a look at the June. Let's say that we want to look at the 243 calls for June. All right, 36 days till expiration. Looking about $3 above at the money. So we're looking at the 243 calls, and right now I'm showing them trading at 96 cents by 99 cents. I'm going to assume that I get filled at a price of 97 cents on those for June. Now, with that being said, let's close that up. Let's go out another month or so. Let's go out to August. If I'm going out to August, I'm going to look at the similar strike price. And this is something to where I feel you'll have to monitor it, but this is definitely something to take a look at. And okay, normally August would work, but it doesn't have the 243 call with which I'm looking for on it. So let's actually go out one more here. Sorry, folks, I did the 243 call. That was the perfect call price for what I was looking to do. And it does not have a 243 for August. So with that being said, let's just go out to July for right now.
Good idea. Great idea, Mike.
Excellent. All right, so for July, let's say that I were to look at the 243 call for July. I own the underlying, and then at the same time, I'm going to sell a covered call on SPY at the 243 level for June. If I go out to July, I can buy one call option for, it's at $1.98 by $2.01. So I'm just going to say roughly $2. So with that being said, I want to talk to you guys about a horizontal ratio spread. And these may or may not be the right months for you, but I think this might be the right time to start looking at such a thing. So let's say that SPY does stay the exact same between now and June expiration, or maybe even goes down a little bit. Or if it does go up, it does actually go to no higher than the 243 level. What I'm proposing is that you might want to consider, and once again, I'm not doing this trade, I'm just doing this for illustrative purposes alone. And as you can tell, I wasn't even planning these exact strike prices based on what I'm getting at right now. But the concept of it, I have been thinking about a lot lately. If you sell the 243 covered call for June, simultaneously buy a 243 call for July, sell another 243 covered call or short call for June, you're creating a 1-by-2 ratio spread and combining it with stock. So you own 100 shares, and you also own a 243 call for July. Now, the 243 call for July cost you a $2 debit. By selling two, not one, but two 243 calls in June, that's going to finance all but a few pennies of that debit. So here's the benefit of what you actually have going for this. You actually have the ability to, number one, still have some upside on the underlying, because we do have about $3.60 of potential upside just on the underlying alone. But at the same time, what this does is this gives you the ability to kind of lock in a longer term volatility. So let's say that you believe that volatility is low right now, and you want to have some upside exposure, and you're just not finding any premium in doing covered calls. Just by doing straight covered calls, there's just not a lot of premium to be had. Well, here's something with which you can consider. If you're actually selling two of those near-term options in June and buying the longer-term option in July, what this ultimately does is this gives you the ability to have a little bit more upside if the stock were to increase, of course, and those June options were to expire worthless. Now, of course, you don't want to have the underlyings expire the options expire worthless, because there's always a move to do beforehand. But this is a way with which you can actually have some type of exposure within the marketplace, be a covered call-esque trader, and have the ability to potentially have some extra deltas that were financed by the market in doing so. Now, this is a negative delta option trade, but it's combined with owning stock. So, for example, the delta on the June 243s is 27. The delta on the July 243s is 33. So you're actually selling 27 times 2 is 54. 54 minus 33 comes out to be 21. So you're actually short 21 deltas on this trade. Similar standpoint to what you would actually be from selling just that June 243 covered call. Once again, the concept behind this is that if you actually have, let's say that theoretically all volatility went higher and market stayed the same. Let's say that we just live in a vacuum, the giant volatility vacuum. If that's the case and volatility goes higher and affects nothing else, then this trade would be beneficial to you because you're short more options than you are long. However, with that being said, you need to have the mentality that this isn't a trade that you just set it and forget it. This is a trade that you need to actually monitor. So if markets go lower, that's a time with which you may want to start to perhaps sell the 243, buy to cover the Junes, and then maybe roll down the Julys, something along those lines. There's a whole variety of things with which you can do with this. But ultimately, let's say the market really doesn't move that much. And we just kind of stay in a range between 238 and 242 between now and 36 days from now, which is June expiration. Then ultimately what you're doing is you're buying back these short calls for a pretty nice profit. And you have the choice of doing whatever you want to do with that July 243 call. And you have some choices. You maybe want to just take the money off the table and enjoy the profit that you have from the Junes. Perhaps you want to roll it out. Perhaps you want to just hang on to it and let it ride. It gives you a lot of choices. And whenever you're doing a calendar or a diagonal like this, choices are infinite of what you can actually do. But this is one thing with which I'm looking at in what I deem or what I consider this to be a lower volatility environment. And what I mean by lower volatility is that I believe over the course of the next few months, I do think volatility is going to go higher. Now, next thing with which you can look at, this would be one that typically would work better in a higher volatility environment. Let's take a look, and it will not work very well right now, in my opinion. Let's take a look at those same June calls and on SPY. Now, this one I'm definitely not even looking at right now because I don't think it would work. I mean, there's always individual stocks things like this could work on, but I don't think this is a good environment for doing this trade. But at some point, we will have higher volatility again, and it will be. Now, let's say that stocks become lower. This is known as a stock repair strategy, or I just think it's kind of a stock enhancement strategy. SPY right now, it's trading at $239.38. The June 241 calls are trading at 176 by 180. The June 243 calls are trading at 96 cents by 99 cents. Now, let's say right now I'm going to make it an actual worse fill than it actually is, just for sake of easy math for people. But let's say that we buy the 241 and we also own 100 shares of stock. Well, we paid $1.80 for that 241 call. It's all time decay. It's all fluff, as a lot of people like to call it. How do we finance that? Well, we have the ability to sell not one, but two 243 calls. And let's say that we sold them for 90 cents each. The two 243 calls, 90 plus 90 is 180. That actually finances the entire 180 call, the entire 241 call. Now, by doing that, you actually create double leverage between 241 and 243. And of course, you don't have anything above 243 that you'll have in profit because that's where you're capped. One of the calls caps the unlimited upside potential of the stock. The other call caps the unlimited upside potential of the call. But what this does do is that if you believe that the stock isn't going to go much further than 243, you have that double leverage. Now, once again, right now in this environment, a lot of times you're not going to get that much of a bang for your buck when doing a trade like this. But when the VIX is to go to higher levels, this is another one to consider if you are looking to delve in the world of ratio spreads. Because, well, let's face it, by doing this trade right now, the only benefit you're getting less than a 1% additional benefit on an index, and you're not getting that benefit until it goes up another 1%. And then you're capping all upside. So I don't know if that's necessarily the best strategy to do right now in general. Now, once again, there's always individual stocks that will be exceptions to the rule, but it is something to keep in your toolbox for a higher volatility later date. And with that being said, that concludes the strategy block for today, May 11th. All right.
What a great block.
Our strategy block is done. Thank you for that, Uncle Mike. Thank you for coming down from the mountains for that and smoking your bubble pipe and donning your fedora and whatever other things I do whenever I come down from the mountains.
You have a fedora?
I think I do. What does Mark say that I have? No, I don't don the fedora. I think I just have a bubble pipe.
Oh, okay. Well, that makes sense.
I think so, yeah. So I don't smoke tobacco, so I guess I need a bubble pipe. That would make more sense. So.
Indeed.
All right, and now we are at the part of the show where we get to hear from our beloved audience, the mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
We are in the mail block now. As we do this, we're going to start off with our question of the week. This volatility implosion is starting to make people nervous. How low can the VIX go in 2017? Poll is still running, but right now, Mr. Sebastian, what would you say of these four choices for the VIX? Choice A, 9 is the bottom. Choice B, no lower than 8.5. Choice C, can't get below 8. Choice D, look out below. It's going below 8.
So I think the audience picked 9. And if you look historically, VIX has touched below 9 intraday once. So I'm going to go with the audience, and I'm going to say 9 is the cheapest we see.
All right. You are correct. 9 is the bottom, is what's winning right now at 38%. Now, guess what? What would you guess second place is in the audience?
8.5.
You are dead wrong. Second place
Really?
at 29% is below 8. Look out below.
Really? Well, that's not going to happen. That's not going to happen. I'm telling you. It's like borderline humanly impossible for it to trade below 8. It just can't happen.
The only reason I would agree with, I'm saying I think we're in the, I'm seeing high 8s personally. But with that, I will say that the only reason I would say that it's not that it could happen is because it seems to defy logic, and the fact that we are into more than 100 days into a Trump presidency and we have such a low VIX, that defies logic to me personally, especially with all the macro events that we've had. So that's the only reason that I would go much lower than we are right now, because it wouldn't make sense. But with that being said, let's move on. We have a question from, this is actually an interesting name here. Tommy Baja at Deplorable88. Thoughts, huge move in Macys volume on the May 30 calls. Contracts like February 20 to 2nd to 3rd takeover news. Earnings surprise, new big stakeholder from Bloomberg. Do you have any thoughts on Macys, Mark? I know you're in the retail space a little bit, or it's something that kind of interests you a little bit. Any thoughts on that?
Well, considering the stock's down $5 today on bad earnings, I would venture to say that maybe those were hedges for a short position or some sort of stock replacement. They got their lunch hand. They got their sack handed to them. Snap got their sack handed to them. It was a sad sack earnings day for a lot of companies.
For sure. All right, and we have a comment from our good friend Russell Rhodes. This might have interest. You might have saw this a little bit earlier in the day as well. 75,000 VIX June 19 calls trading at 50 cents. Any thoughts on that?
I saw it, and I almost traded it. I did not. This is there's a customer that likes to come in and hedge using VIX that does some complicated stuff, and he likes to buy options around 50 cents. He's nicknamed 50 Cent, and personally, I liked it. I almost traded. What was unique about this one was the customer did them straight up in the crowd. They wanted crowd help. Sounds like the bank that usually puts them up didn't want as much of it as they normally do.
Got it.
But I think it's a hedge, and I wouldn't get overly excited about it.
For sure. All right. Final question that we're going to do today. Question from Fund Concept. Doubt that Trump will get rid of H-1Bs, considering global talent is crucial for the U.S. economy. Any thoughts? From Diamond, I'm guessing this means for Jamie Dimon. The U.S. is hurting the economy by forcing great talent overseas. Now, What are some of your thoughts on that? Because one of the things that we have in general, with Trump being elected, is that he was elected on we're going to make America great again and have more jobs in the U.S. But with some of his policies, it can motivate businesses to kind of do more things overseas. I mean, what are some of your thoughts on that, Mark?
Well, I mean, I think this is a bad deal for the outsourcing firms, and a good deal for firms that actually want to hire talent from outside the United States. There was most H-1B visas are granted for all the right reasons and because the companies need them. There are a few consulting companies and outsourcing companies that would flood the system trying to get as many, because it's a lottery system right now. The movement toward need/priority, and the movement toward getting real needs filled, as opposed to some of these consulting firms, I think is a great idea. Some of the other things, I don't love the rhetoric, but if they do overhaul the H-1B program to the benefit of U.S. companies, that could be great. Another thing I'd like to see is, we have the best university system in the world, and we have a large group of out of state or out of country students. It'd be great if we could keep some of that talent in the United States. I think that would be a huge advantage to the overall U.S.
Oh, no doubt about it. For sure. I mean, how many people, there's people in the U.S. that do go and study abroad, and there's a lot of great universities abroad, but overall, I mean, what other country in the world has as many colleges as we have, and that even a kid that doesn't have the money to go to college, he can usually scrape together a few $100 to go to a junior college in his area and still get a better education than probably, I would say, 95% of the world. So anyway, with that, we are done in our mail block segment for today, and we are going to move on to a round the block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
And welcome to Around the Block. This is where we talk about what's going to happen around the block. So, Mark, what's going to happen? What are you guys looking at? What do you think is going to go on over the weekend? Things that are going to be happening for next week. What is wetting the whistle of the option pit?
Today's hearings were interesting. I think we could go back into the vat of nothingness. Earnings season is done. I'd like to see, I'd like to see some sort of catalyst push us higher. My gut still says that we go higher, but I'd like to see a catalyst, and right now I don't see one. So we might be in for another week of chop around this 2400 strike, which seems to be a magnet right now.
Yeah, I would agree with that. It seems like we can't quite break through it, but we're really not that far from it at any time. Yeah, and just what I'm looking at, saying that 2400 is something with which I'm very laser focused on right now for the SPX. We're not getting that far from it. I'm continuing to watch gold and silver, of course, like I always do. Silver is actually getting close to its 52-week low. I thought we might hit it actually earlier this week, but we did not. So now silver is almost right back to where I got into it at in the beginning of the year. So my longer-term collar that Longo gives me a hard time about, that we had much fanfare about it, but I've ended up not having any good adjustments to give on the show. I thought it was going to be Apple Part 2, quite honestly, but it's actually been the biggest letdown ever in terms of adjustments for show purposes. Happy with what it's doing, but just haven't had all the adjustments that would be good for the show, so to speak. Not that that's why we trade, but nonetheless, that's kind of where it's at. So I'm watching that. And then just, I would say, I think oil as well. But once again, the 2400 is the mark of marks at this point. So with that, when you pit chatters are not watching the 2400 level, I'll do my best, Mark Longo here. Where can our listeners go to find a masterclass?
Yeah, go to optionpit.com/events. We also have a new service called the Option Wheel. It's the weekly Option Wheel. It is a weekly letter that we put out that puts on wheel trades where we sell a put to try and get into the stock and then sell covered calls to get out. We put out, we'll carry between 4 and 8 ideas at any given time, and we actually manage them. And it's obviously for education purposes only. But right now, you can watch my last webinar, Riding the Wheel, and try it for a month for $7 by going to optionpit.com/option wheel.
Got it. That's the cost of a commission at most brokers.
It is. It's the cost of a cup of coffee of a venti cafe double mocha at Starbucks.
For sure. All right. Well, ladies and gentlemen, that concludes today's episode of the Option Block. For more shows, make sure you're tuning in to theoptionsinsider.com. And if you would like a financial advisor, feel free to give me a call at 312-212-3531 or shoot me an email at mtosaw@rcmfs.com. So with all of that, for my partner, Mr. Mark Sebastian, who is not Andrew's sidekick. Andrew's his sidekick. We'd like to thank everyone for listening. Wish everybody well, and have a great weekend, everyone. So long.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.